Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar plunged rapidly this week, losing over 3% at one point, and pulling back to levels below 104.0, nearly erasing gains since Trump's election victory. The US dollar has been actively declining since early February and intensified the decline at the start of this month. An attempt to climb above the 50-day average at the end of February was met with intensified selling, and this week, the price has already pulled back below the 200-day. A popular explanation is that the dollar is suffering because of Trump's tariffs. It is correct to call the dollar's decline a reassessment of expectations for the US Fed key rate. The odds of 2 or more key rate cuts before the end of the year exceed 90% versus 48% 2 weeks earlier. A big EU defense spending plan and a dramatic shift in budget planning approaches in Germany lead to lower expectations for a key rate cut. This news has caused the single currency to rally against most of its peers, most notably in the pairing with the dollar, where we have seen a 4.5% rally since the start of the week. Higher than expected inflation in Japan is also setting the stage for a key rate hike, perhaps as early as March 19th. In other words, the gap in monetary policy is closing rapidly on both sides. US indices declined in unison with the dollar, although they usually go in the opposite direction. But not all is terrible. The S&P 500 and NASDAQ 100 indices we're getting support on declines towards the 200-day moving average. That's a long-term trend signal line for many of the big players. A failure below it could mean a regime change for stocks from buying on dips to selling on growth. The S&P 500 has already broken a year-and-a-half upward trend and settled dangerously at levels just below 5,800, testing buyers' resolve almost daily. A failure of this support would activate an accelerated downside scenario into the 5,200 to 5,300 area. For the NASDAQ 100, which is now near 20,000, a sustained move lower may not have meaningful headwinds until 18,000. The beginning of recovery from this area will allow us to talk about the start of a new impulse with the potential to renew historical highs as the accumulated oversoldness is whetting investors' appetite. It is a completely different story in Europe, where the German DAX 40 continued to rewrite historical highs at its peak, showing an 18% increase since the beginning of the year. The new government's plans to spend money on stimulus, setting aside self-imposed constraints in the form of budget deficits and debt-to-GDP ratios, sparked a sell-off in bonds. But this sell-off is in anticipation of a larger supply of government debt, not because of fears about Germany's solvency. We are seeing a flow of money into euros and equities, not a flight from the region like during the Greek crisis. Since early March, the gold price has reversed to the upside, regularly exceeding the $2,900 mark during the week. The cautious trading tone of the US indices works on the side of the bears, while the weakness of the dollar infuses confidence in the bulls. On the tech analysis side, the dip at the end of last month now looks like a corrective pullback from the rally from the beginning of the year. If this is the case, overcoming the highs above 2,950 opens the way to 3,180. Gold bulls should still look at the sentiment around US equities. Further declines could switch the market into global deleveraging mode, and gold will initially have a tough time. Crypto market capitalization returned to the $3 trillion area towards the end of the week, ahead of the first crypto summit in the Oval Office. In the short term, buyers on downturns were strong enough to buy back 2 powerful sell-offs. However, an important test of the previous support level at $3.15 trillion is ahead. Sentiment is moving away from the low point, but remains in the fear territory at 34. As intended by the creators of such indices, a recovery from this area represents a buying opportunity. we still consider the market reaction after Friday's summit to be an important confirmation signal. Bitcoin is gaining for the third day, having pushed off from support in the form of the 200-day moving average. The ascent is more measured this time compared to the market pumping last weekend. But we are cautious of talking about a bullish victory until it breaks above the 50-day moving average, which is now at $97,000. Ethereum is trading near $2,300 and trying to break out, but for now, it remains below levels before the Republicans won the election in November. So far, its momentum should be characterized as a technical rebound after a strong sell-off rather than the start of a recovery. The focus returns to inflation in the new week. On Sunday, China is expected to report negative year-on-year inflation in consumer and producer prices. This may trigger a new wave of deflation talks in China, which will affect market sentiment at the start of the week. The US will release its consumer inflation data on Wednesday and producer price change on Thursday. The main concern of the markets is whether the US is already facing a new wave of inflation, which the new tariffs promise to spur further. On Wednesday, the Bank of Canada will announce its decision on the key rate. It is currently at 3.0%. But because of the tariffs, some economists say a big cut is now possible. For now, we expect a quarter-point cut and a willingness to cut it further. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.